Good day. My name is Leta Kanjo, and I'll be taking you through income tax return. Let's look at the content. We've got our introduction of what income tax is, gross income, exempt income, as well as allowable deductions, fringe benefits and allowances, employee tax, taxation of non-residents, taxation of business entities, turnover, and completing tax returns. Unit 3 focuses on exempt income, which entities are exempted from tax. These entities can be completely exempted from the payment of tax on their income. Income exempt from tax, which is income totally exempted from tax. That income is not taxable at all. An example of such income are like dividends as well as interest received. The following are exempted in terms of Section 10 of the Income Tax Act, such as the government receipt and accruals, foreigner government agency appointed by that government to administer development assistance agreement, any multinational organization providing donor funding as per official development assistance agreement, pension of the Namibian resident and his surviving spouse, and salary of foreigner diplomat, as well as exempt income. The following are also exempted: receipt and accruals of any institution or body, any board established to conduct scientific, technical, or industrial research. Institutions such as IOL, UNAM, and Polytech might be exempted from tax due to the fact that they are conducting scientific, technical, or industrial research, or they provide necessary commodities and services to the public, and they render financial assistances designed to promote commerce, industry, or agriculture. Exempt income also consists of levies, which are received by body corporate or share block companies are exempted. Pension, war pension, and any award in respect of diseases contracted by a person in mining operations are also exempted from tax. Income received by those war pensioners who are working in mining operations are also exempted from tax, and any disability pension. Any pension that's related to the disability, to any disability payment or benefit are also exempted from tax, and insurance benefits. Any receipt and accrual from any policy where the premiums have been included in the income of the employee as taxable fringe benefit are also exempted from tax. Then let's look at Unit 4, which consists of allowable deductions. And this consists of general deductions as well as specific deductions. Section number 11 of the Income Tax Act provides that for the purpose of determining the taxable income derived by any person from carrying on trade, they shall be allowed as deductions from the income of such person. General deductions continue. The requirement for any expense to qualify for deductions in terms of the general deduction formula, these are the requirements for expenses to qualify as deductions. The taxpayer must be carrying on trade. There should be trade to be carried on. The taxpayer must derive an income from carrying on that trade. There should be income derived from that trade that is being carried on, and the amount claimed must constitute an expense or a loss. The amount claimed should be an expense or a loss for it to qualify as a deduction, and the expenditure or loss should be incurred in the year of assessment. And the expenditure or loss should be incurred in the year of assessment, and our year of assessment in this case always applies to the 28th of February is the year end, and commences on the 1st of March from any year. Expenditure or loss should be incurred in the production of income. Those expenditures or losses to qualify as a deduction should be incurred in the production of income. when you are carrying on that specific trade, and the expenditure or loss must not be of a capital nature. Expenditure or loss must not be of a capital nature, and expenditure or losses must be for trade purposes. Expenditure or losses must be for trade purposes. And then let's look at the specific expenses. These are fixed assets. Loss of a fixed asset is not deductible, as fixed assets are of a capital nature. In trading stock, losses due to theft, fire, or damage are allowable. As cash, loss of cash due to burglary or misappropriation is allowed to the extent that it's recovered through insurance contract. And let's look at units 5 and 6 consist of fringe benefits and allowances. Fringe benefits refer to the payment made to employees by employer in a form other than cash. Let me say an employee making use of the company is more like a fringe benefit, and allowances is often given to employees to cover any expenses that they might incur as a result of the employment. And allowance is more like part of the job agreement that you are given money, or you are given a company assets or anything to consume as part of the job. Travel allowance, when a person is expected to travel, we've got travel allowance, which is given when a person is traveling, and the full 100% of the travel allowance is included in gross income when performing the annual tax calculation. The full 100% of the travel allowance is included in gross income when performing the annual tax calculation. And travel allowance deductions can be claimed by actual expense listed in the tax return, and the deduction should be limited to the amount of the allowance. Actual business kilometers and deemed cost per kilometer. This can be claimed where an actual logbook is kept detailing all business travel. A logbook should be kept which will be giving details of all the trips that have been taking place and the kilometers and the distance. That's what to say. Travel allowance. Amount allowed as deduction will be calculated as the amount which will be allowed as a deduction in the form of a travel allowance will be determined by taking your fixed cost, the company fixed cost, divided by the total kilometers traveled. Then you add the fuel cost plus repair cost. Maybe the vehicle or the car that's being used needs some repair. So you plus the fuel cost and the repair cost. Then you multiply by the business kilometers. Let's look at units 7 and 8. Taxation of residents and business entities. Residents refer to someone who is either a Namibian or who spends a certain number of days in Namibia, and this can be a natural person or an ordinary resident. A natural person can be a non-natural person. Can be a company. A company can be treated as a resident if it's incorporated, established in, or if it's established in Namibia. Non-natural person refer to companies and close corporations and all those non-natural person. Natural person refers to the real person, or at least a non-juristic entity. Taxation of non-residents. Any person who is not a Namibian resident. Taxation of non-resident. Any person who is not a Namibian. That's what taxation of non-residents refers to. It's only applicable to those people who are not Namibian residents at all. And the source for rules for various types of income are as follows. Category taxation for non-residents. So with the business category of income, then we have got the Namibian source and Namibian source if the business is carried on in Namibia, the business income, so if it's only taxable if the business income is only taxable if the business is carried on in Namibia, or let me say trade is being carried on in Namibia, then it's taxable. And remuneration and fees, services are rented in Namibia, So it's only taxable if services are rented in Namibia, then we'll tax that income from the services rented. Then the rental income fixed properties. Rental income from fixed properties which are situated in Namibia are deductible as well as taxable in Namibia as well. And the rental income from movable properties, they are also taxable and deductible in Namibia if the property is in Namibia or its properties are located in Namibia. And royalties, the intellectual property which produces them was developed in Namibia. If, let me say, you have got a brand or a logo, so if this logo or brands were produced in Namibia, then those royalties as a form of income are taxable in Namibia as well, although they are being made by non-Namibian residents. And dividends, they are declared by a Namibian company, so they are also taxable under non-residents. And you've got Unit 9 and 10, turnover tax and tax return. So the rates applicable to both natural and juristic persons is here. So if someone earns between 0 to 150,000, it's a 0 rate per year. So if you earn between 0 to 150,000 in a year, nothing will be taxable. And earning between 150,000 and 1 to 300,000, 1% of the amount above 150,000 is taxable. Then earning between 300 and 1,000 to 500,000, 1,500 plus 2% of the amount above the 300,000 is taxable. So 1.5 plus 2% of the amount above 300,000 is taxable if you are within that range. Then earning between 500,000 and 1 to 750,000, 5,500 plus 4% of the amount above 500,000 is taxable, and 7,501 and above, so you'll be taxed by 15,500 plus 6% of the amount above 750,000. Then turnover tax. Who qualifies for turnover tax? Any natural or juristic person with amount not exceeding 100,000 qualifies for turnover tax. And in case of a partnership and close corporations and companies, all shareholders must be natural person. So for any shareholder must be a natural person for them to qualify for turnover tax. A person might not in any time of the year hold shares in another company, and the person must not in any time of the year hold shares in another company. Why must we pay tax? So tax is a form of revenue for the government to provide for the poor, educate its citizens, and provide basic health care, maintain and improve infrastructure. Different types of taxes paid. You've got income tax, turnover tax, property tax, value-added tax, and excise and custom duty. Who's liable for income tax? A natural person or individual or juristic or legal person. The language of income tax. The income tax is a separate tax governed by the Income Tax Act number 62 of 1962. And types of tax, we've got normal tax, donation tax, turnover tax, dividend tax, and withholding tax. Tax year of assessment. A tax year of assessment is always runs from the 1st of March to the 28th of February each year, as I said already. And the year of assessment is the 12-month period ending on the 28th of February. Taxable income and income tax. Income tax is a tax levied on the taxable income of a person for a specific year of assessment. Basic formula for the calculation of taxable income. We've got the gross income. The gross income, which will maybe consist of your salary, the travel allowances, your medical aid, in other allowances as well, then you less the exempt income which is not taxable, then you have income. Then from that income you again subtract the allowable deductions. Then after allowable deductions you add taxable portion of a capital gain, then you get your taxable income. Then you have got taxable income of a business, different from income tax in that certain income are exempted from tax and certain expenses are allowed as deductions. Let's see, for a business, the taxable income is not like for an individual. For a business, they will have a turnover, which will maybe be profit or a gain, less the cost of sales. Then you get your gross profit. Then you add other operating income, gross profit plus other operating income, gross profit plus other operating income, gross profit. We have got turnover, less cost of sales, add other operating income, you add other income, you got turnover less cost of sale, you get gross profit. Gross profit plus other income, and you get gross operating income, then you less expenses, then you have your net profit. This will be our net profit. And we got the rates of tax applicable to companies and closed corporations. 28% was applicable from the 1st of April 2008 onward. Then 29% was applicable from the 1st of April 2005 to the 1st of March 2008. And 30% as a tax rate was applicable from the 1st of April 1999 to the 1st of March 2005. This was back then. Then 35% was applicable from the 1st of April 1994 to the 31st of March 1999. Then 40% was applicable from the 1st of April 1993 to the 31st of March 1994.